thrilled to have so many brokers and employers attending today. For me personally, it is very, very gratifying to see how much strong interest there is in the 2018 group health plan requirements. We've got a lot of ground to cover, so I just want to give you one quick note before we begin the presentation, and that is all the content, all the requirements and information that you're going to be seeing during the webinar and learning about has been prepared by HR 360's team of staff attorneys. So we're all set to go. And without further ado, John, let's hit the first slide. Thank you. This is a very important opening statement for all of our folks out there. First and foremost, it's important to basically emphasize that the entire body of requirements and law is still in effect as I speak today in 2018, and that's despite repeated attempts to repeal and replace the Affordable Care Act, or as we know it, ACA or ACA. We like to say it's all happening in, of course, Washington, D.C., but it's important to note and to emphasize that currently all ACA requirements remain in effect for 2018. Now, if there are any changes that will be transpiring at all during this year, we'll be sure to communicate that through the HR 360 library, news alerts, and newsletters. But this is where it is right now. Everything is still in effect. So let's continue on, John. Thank you. So now we're going to be talking about ACA's pay or play provisions. For employers, the ACA's pay or play provisions are most key. These two provisions mandate that applicable large employers, generally those with 50 or more full-time employees or full-time equivalent employees on average during the prior year, comply with two key requirements. First, applicable large employers or ALEs. Now, you'll hear me say ALEs during the course of the presentation, but I will give you the acronym and, of course, the full name itself, just for those folks who are still acclimating to that's the whole concept of applicable large employers or ALEs, are required to offer affordable coverage that provides minimum value to all full-time employees and their dependents. We'll define what the terms affordable coverage, minimum value, full-time employee, and full-time equivalent employee mean during this presentation. So we're going to cover all of it. In addition, ALEs or applicable large employers must comply with an information reporting requirement. This requirement mandates that they file forms 1094-C and 1095-C with the IRS and furnish a form 1095-C to all full-time employees. Failure to comply with these requirements can result in substantial penalties. However, remember that employers with fewer than 50 full-time employees or full-time equivalent employees are generally not subject to pay or play. So very important to remember that this is 50 or more. That's what we're talking about, employees or equivalent with the pay or play provisions. But generally speaking, less than 50 or fewer than 50 full-time employees are generally not subject to pay or play. So let's continue on to the next slide. Thank you, John. So now we're going to talk about what is affordable coverage. We've heard it over and over again through all these years of the law being in effect, and we're going to talk about it now. For calendar year 2018, coverage is generally considered affordable if the amount the employee contributes towards his or her own coverage does not exceed 9.56% of his or her household income. However, because employers generally do not know their employees' household incomes, the IRS has stated if the employee's contribution towards his or her own coverage is less than 9.56% of his or her Form W-2 wages, the coverage offered is deemed affordable for purposes of pay or play. So it's important to, again, I'll state it, the IRS has stated if the employee's contribution towards his or her own coverage is less than 9.56% of his or her Form W-2 wages, the coverage offered is deemed affordable for purposes of pay or play. And as John said, you know, we're going through a lot of important information, and it's detailed, and we totally understand that. And that's why you're going to get a copy of this webinar recording and a copy of the deck or the slide presentation that we're using, so that you can forward it on, you can study it, you can take notes as you listen to it again if you didn't quite get everything this time around. But we know how important it is, so that's why we're absolutely going to provide you with the additional information after the webinar is over. Now, let's move on to the next slide. Thanks, John. We're now going to handle and take on what is minimum value coverage. Under the ACA, a plan is deemed to have provided minimum value if it, number one, covers at least 60% of the total allowed cost of benefits that are expected to be incurred under the plan. Secondly, it provides substantial coverage of inpatient hospitalization services. And finally, it provides substantial coverage of physician services. To help you determine if your plan provides minimum value, you can download a minimum value calculator from the Centers for Medicare and Medicaid Services at cms.gov. Now, just a moment to just say that, you know, a lot of our tax dollars goes to maintaining and building out sites like DOL.gov and CMS.gov. And there's some very, very valuable information and tools on these systems. And we're going to be referring to it in the context of a particular point that we want to make, or a piece of information or content. But it's not a bad idea to just go visit and see what's there, because it's very, very important to really kind of know what the government is putting out there. So just a little bit of side information for you. So let's move on, John. Thank you. Now we're going to be covering who is a full-time employee. For purposes of pay or play, an employee is a full-time employee for a calendar month, that's a calendar month, if he or she averages at least 30 hours of service per week. 130 hours of service in a calendar month is treated as the monthly equivalent of at least 30 hours of service per week. So I know there's a little bit of math going on there in numbers, but it's important to note this. And then we're going to talk about right now the fact that there are two methods for determining full-time employee status. First, there's the monthly measurement method, under which the employer determines if an employee is a full-time employee on a month-by-month basis by looking at whether the employee has at least 130 hours, that's 130 hours of service for each month. There was also something called the look-back measurement method, under which an employer may determine the full-time status of an employee during a future stability period based upon the hours of service of the employee in a prior measurement period. However, this method may be used only for purposes of determining and computing liability, and not for determining whether the employer is an ALE or applicable large employer that is subject to pay or play. So there's a lot of information on these two very distinct measurement methods. And again, you'll have copies of the presentation afterwards so that you can look at it and carefully note it. And we will now continue on, John, to the next slide. Thank you. So now we're going to talk about who is a full-time equivalent employee. You hear that a lot, full-time equivalent employees, and we're going to explain that now. Full-time equivalent employees are counted by combining the hours of part-time employees, each of whom individually is not a full-time employee, but who in combination count as one or more full-time employees. An employer determines its number of full-time equivalent employees for a month by first combining the number of hours of service of all non-full-time employees for the month, not including more than 120 hours of service per employee, and then dividing the total by 120. However, for purposes of pay or play, the number of employers' full-time equivalent employees is only relevant for purposes of determining whether the employer is an ALE or applicable large employer. Remember, if an employer has 50 or more full-time employees, including full-time equivalent employees, on average during the prior year, the employer is generally an ALE or applicable large employer for the current calendar year. See, there's a lot of calculation going on here that has to happen to make this full determination, which has been covered in the last few slides and, of course, this slide. So it's very, very important that the math and the measurements and the tracking is done in a very careful and detailed manner. And again, for all those folks out there who think, well, you know, they're trying to do repeal and this and that and all this various activities are going on in Washington, I'm here to tell you, you have to keep doing this. There is no cessation. There is no stopping what the law requires, which is on the books right now, which is all of the information, the tracking, measurement, and so forth that I have just described. So please, please continue to do this process. So let's continue on, John. We're going to talk a little bit about pay or play penalties. Now, there are some substantial penalties that can result from non-compliance with pay or play. For 2018, an ALE or applicable large employer will generally owe a penalty under either of two scenarios. First, if the ALE does not offer coverage to at least 95% of its full-time employees and their dependents, and at least one full-time employee receives a premium tax credit to purchase individual coverage through the health insurance marketplace. Under this scenario, the ALE may owe a penalty of $2,320 for each of its full-time employees. However, if the ALE offers coverage to at least 95% of its full-time employees and their dependents, but at least one full-time employee receives a premium tax credit to purchase individual coverage through the health insurance marketplace, the ALE may owe a penalty of $3,480 for each full-time employee. That's $3,480 for each full-time employee that received a premium tax credit. So two different ways of looking at this. Under this second scenario, a full-time employee may be eligible for a premium tax credit because the coverage offered was deemed unaffordable or did not provide minimum value. That's why it's so important to understand the definitions and to comply with the requirements related to minimum value. So again, there's math here, different penalties, but the penalties are real. And it's very, very important to pay attention to these because there is liability, there is exposure if for non-compliance. That's the bottom line. So let's continue on, John. Thanks. And now we're going to talk about enforcement of pay or play penalties. After several years of delay, enforcement of pay or play has begun. The IRS is now mailing letters to ALEs, informing them of their potential liability for a pay or play penalty related to the 2015 calendar year. However, before any penalty is assessed and notice and demand for payment is made, ALEs will have an opportunity to respond by the response date shown on the letter, which generally will be 30 days from the date of the letter. The letter will also contain the name and contact information of a specific IRS employee that the ALE should contact if the ALE has questions about the letter. If, after correspondence between the ALE or, of course, the applicable large employer and the IRS, so, you know, there's a correspondence has been going back and forth, the IRS determines that an ALE is liable for a penalty, the IRS will assess the payment and issue a notice in demand for payment by a notice CP 220J. That notice will instruct the ALE on how to make payment. Please note, however, that ALEs will not be required to include the payment on any tax return. So that's the bottom line. I know we've been waiting and waiting to see what's going to happen in terms of actually enforcing pay or play penalties, and it is happening. Just bottom line. So it's very, very important, and we took the time to give you this detail to convey the message that this is real. The penalties are real. The compliance must be completed and done within the framework of what the ACA or ACA requires, because these letters are going out and it's happening. So please, let's be very, very careful about compliance. And please, after the webinar is over, just go back and be sure to, read the webinar or listen to the webinar and closely pay attention to the copy of the deck. And if you have the HR library, there's lots of great tools and information on that system as well. But again, compliance is key. So let's continue on. Thanks. So now we're going to be talking about information reporting requirements and penalties. Employers are subject to separate penalties for failing to comply with the ACA's information reporting requirements. Under these requirements, ALEs, or applicable large employers, must file, ready, Forms 1094-C and 1095-C with the IRS by February 28th, 2018, or April 2nd, 2018, if filing these forms electronically. So a difference in deadlines, but of course one is for filing the April 2, 2018 is for filing the forms electronically. Please keep in mind that if filing 250 or more forms, 1095-C, these forms must be filed electronically. Again, so if you reach that critical amount of forms, must be filed electronically. Employers must also furnish a Form 1095-C to each full-time employee by March 2nd, 2018. All these deadlines are coming up. Very, very important. Failing to comply with either of these requirements may result in penalties of up to $260 per return. So it's really, really important. Again, we're laying this out for you to just remember compliance is key. These are the penalties. These are the deadlines and requirements. And let's just make sure that we're doing what we're supposed to be doing. So let's continue on. Thanks. So now we're going to be talking about Form W-2 reporting requirement. In addition, employers that provide a group health plan to employees and file more than 250 Forms W-2 are generally required to report the cost of the coverage provided to each employee annually on his or her Form W-2. In general, the amount reported should include both the portion paid by both the employer and the employee. Employers are to report this amount using Box 12, Code DD of Form W-2 by January 31, 2018. So that is coming right up. Failure to comply with this requirement may also result in penalties of up to $260 per return. So let's continue on. Thank you very much. Now we're going to switch to a different set of requirements, and it's something that all of us, I think, know a fair amount about, but very, very important to cover. And those are benefits notices requirements. Employers sponsoring group health plans are also subject to numerous benefits notice requirements depending on the features of their plan. Some of the more common required notices are the Summary Plan Description, SPD, and many of us know it as WRAP SPDs, Summary of Benefits and Coverage, SBC, and may I add that sometimes there's a confusion between what an SPD is and an SBC, and they're entirely different. Health Insurance Exchange Notice, Employer CHIP Notice, Notice of Special Enrollment Rights, General Notice of COBRA Rights, and Summary Annual Report. And we're going to discuss these notices in more detail, and let's continue on so we can do that. So now we're going to talk about summary plan descriptions. It's something that a lot of folks out there have heard about and hopefully are complying with. Group health plans must provide group health plan participants with a summary plan description, or SPD, very important now, within 90 days after he or she becomes a participant in the plan. Among other things, an SPD must generally describe what the plan provides, how the plan operates, when an employee can begin to participate in the plan, when and in what form benefits are paid, and how to file a claim for benefits. Failing to provide an SPD may result in a penalty of up to $110 per day per participant. And let me just add that HR 360 has a wrap SPD generator. There are many out there. Brokers will and do provide them to their employer groups. Employers may also basically subscribe or access systems like this. There's all manner of ways to get them, but it's very, very important to remember that this is an ERISA requirement, and as such, it should be complied with. And a while ago, HR 360 had done a kind of a survey of about 1,000 brokers across the country, and it came up that this is one of the requirements that a fairly significant number of employers out there were not complying with. And so I'm here to tell you that it's very important. In the event of a DOL audit, it is absolutely a notice or a document that will be required or requested by the DOL investigator. So it's just important to comply with this. And of course, you also see that there is some potential for penalty as well. So let's continue on. Thanks, John. Now we're going to talk about a different notice, but sometimes people get confused between them. It's called a summary of benefits and coverage, or an SBC. Group health plans must generally provide all plan participants and beneficiaries with an SBC at specified times during the enrollment process and upon a participant or beneficiary's request, generally as follows. Prior to initial enrollment in the plan, upon renewal of plan coverage, thirdly, within 90 days of special enrollment, and within 7 business days following receipt of a request. So these are definitely different requirements, all very important. Sponsors of fully insured group health plans can often obtain the necessary SBC directly from their insurers. The penalty for each failure to distribute an SBC can be as much as $1,128. So employers should be sure to fully comply. Again, many times the SBC does come from insurers, and so that's nice to know and important knowledge to keep in mind. But at the end of the day, when you look at this penalty, it's important for the employers out there to be sure to fully comply with this. It's a lot of money. So let's be sure. And please, now that you know the description that we just gave you on an SPD, summary plan description, this is different. The SBC is a separate notice completely. So let's move on. We're now going to talk about the health insurance exchange notice. So this notice must be provided by all employers. Now this is important to emphasize here, to all new employees, regardless of whether the employer has a group health plan and whether the employee is a participant. So what's important to note here is that if it's a new employee, if there's a new employee, they get this health insurance exchange notice. This notice must be provided to each new employee within 14 days of his or her start date, and serves to inform the employee that the health insurance marketplace exists and that he or she may lose employer contributions upon purchasing marketplace coverage. To help employers comply with this requirement, a model health insurance exchange notice is available from the U.S. Department of Labor at DOL.gov. And of course, it's on the HR 360 library site, but there is certainly an easy way to get this from DOL.gov. So really no excuses. It's got to be done for the new employees within that time frame. So let's continue on. And next, we're going to talk about the employer CHIP notice. Employers that provide group health coverage in states with premium assistance through Medicaid or the Children's Health Insurance Program, that's CHIP, must provide an employer CHIP notice to all employees annually before the start of each plan year. This notice may be provided with enrollment packets, open enrollment materials, or the SPD. A downloadable model employer CHIP notice is available from the U.S. Department of Labor at DOL.gov. Employers that fail to provide employers with an employer CHIP notice may be subject to a penalty of up to $114 per day per violation. So for the employers out there who basically have to comply based on these requirements, that's a pretty stiff penalty. So it's important to take this notice requirement very, very seriously. And I might add, if an employer happens to have the unfortunate situation where they are audited by the Department of Labor, the DOL typically requests quite a few benefits notices, required benefits notices. So it's important ultimately to just comply with as many of these as required and as you possibly can out there, because that's the law and you want to make sure you're in compliance. So let's continue on to our, hold on here. Okay. We're going to continue on to our notice of special enrollment rights. So, in addition, group health plans are generally required to distribute a notice of special enrollment rights to an employee eligible to enroll in the group health plan at or before the time the employee is initially offered the opportunity to enroll. This notice must describe the group health plan's special enrollment rules, including the right to specially enroll with at least 30 days of the loss of other coverage or of marriage, birth of a child, adoption, or placement for adoption. So there are very specific life cycle events. Failure to distribute this notice may result in a $110 penalty per day per violation. Employers can download a model notice of special enrollment rights from, again, the U.S. Department of Labor at DOL.gov. So this is not uncommon, this type of situation where there are special enrollments due to life cycle events as described and so forth. So it's important to make sure that that notice is distributed as we have talked about. And of course, again, very easy to download, and we know the penalties. So let's move on. Thank you. So now we're going to talk about general notice of COBRA rights. Group health plans sponsored by employers with 20 or more employees must provide a general notice of COBRA rights to covered employees and their spouses within the first 90 days of coverage. So again, it's a general notice of COBRA rights to covered employees and their spouses within the first 90 days of coverage. This notice must provide information on the right to purchase temporary extension of group health coverage when coverage is lost due to certain qualifying events, such as termination of employment or a reduction in hours of employment. Failure to distribute a general notice of COBRA rights may result in a $110 penalty per day per violation. To help employers comply, a model general notice of COBRA rights is available from, again, the DOL.gov website. And I have to tell you, this again is one of the ones for the folks out there who have 20 or more employees. You know, it's a very serious situation if an employer doesn't comply with this specific required notice. You know, a lot of times folks in a smaller company get busy. They just kind of try to keep going, keeping the lights on, just managing all their employees. Many times there's no HR person on staff, if you will, and so forth. So sometimes, you know, they can miss compliance with a number of these notices, but it's very serious business, as you can see from the penalty. And so the prudent way is not hard to download, not hard to get a hold of. And like I said, if you've got the HR library, they're all there. And for the brokers out there of a benefits notices generator for their clients from HR 360, you can generate a lot of these notices. But the bottom line is it's just so much easier to stay in compliance and avoid the potential for this kind of penalty. easy to do. It just requires a little focus and attention on this particular requirement. So let's continue on. So we're going to talk now about summary annual report requirements. Group health plans with 100 or more plan participants, now we've taken a sizable jump, at the beginning of a plan year are generally required to furnish a summary annual report, or also known as SAR, to each health plan participant within 9 months after the end of that plan year. As a result, the deadline for calendar year plans to satisfy the SAR or SAR requirements for plan year 2017 is September 30th, 2018, keeping in mind that time frame. Among other things, an SAR or SAR must provide the following information on plan year 2017. Ready? Name of the insurer, total premiums paid, value of plan assets at the beginning and end of the plan year, amount of plan expenses. Failing to distribute a summary annual report may result in a $110 penalty per day per participant. And again, for more information on this, please do visit the DOL.gov website. And so now we're going to move on to our next slide, and we're going to be talking about additional requirements. Additional requirements are imposed on group health plans by the ACA and other laws. Among these are the requirements to offer coverage to dependents up to age 26, limit coverage waiting periods to 90 days, distribute any medical loss ratio rebates received from insurance companies, pay Patient-Centered Outcomes Research Institute, as we all know them, PCORI fees. A lot of times, and most folks don't actually say the full title of that fee, but I thought good to know. We all know and have heard about PCORI fees to the IRS if offering, remember, a self-insured plan, including health reimbursement arrangements not treated as accepted benefits. Filing Form 5500 with the DOL if the plan has 100 or more participants at the beginning of the plan year. Also very, very important. And by the way, just a little sidebar note, if there are mistakes on a Form 5500 filing, that also can lead to a trigger potentially for a DOL audit. So you want to make sure that those all of that information is accurate, and so it's not enough to just file. You've got to file and you've got to do it accurately. So let's continue on. We're going to talk about dependent coverage requirement, the dependent coverage requirement. First, let's discuss what it's all about. When a plan offers coverage for dependents, it must continue to make the coverage available until a child reaches the age of 26, even if he or she has been offered coverage through his or her own employer, is married, no longer lives with his or her parents, is not a dependent on a parent's tax return, or is simply no longer a student. Failure to comply with this requirement may result in a $100 excise tax and additional ERISA penalties. Please note, however, that individual states may have dependent coverage requirements that are even more favorable to employees. So it's, again, so you've got to tune in to your state requirements as well. Employers and plan administrators should consult with their state insurance departments to determine whether additional requirements apply to their plans. So, a lot of times folks think, well, gee, I've got all these federal requirements, under the ACA and just generally, and well, is this not good enough? And I guess what we're saying is, no, it's not actually good enough. And you do have to check with the state that you're located in, for all the employers out there, to make sure that there are no additional requirements. Super important. So let's continue on. So now we're going to talk about the limit on waiting periods. A waiting period is the period of time that must pass before coverage for an employee or dependent who has met the plan's substantive eligibility requirements and has become effective. Under the ACA, after an individual is determined to be otherwise eligible for coverage, he or she cannot wait more than 90 days before coverage is effective. All calendar days are counted for purposes of the 90-day limit, including weekends and holidays, beginning on the individual's enrollment date. So I'm going to just kind of reiterate it one more time, then I'm going to give you an example. So a waiting period, again, is a period of time that passes or that must pass before coverage for an employee or dependent who has met the plan's substantive eligibility requirements and can become effective. Under the ACA, after an individual is determined to be otherwise eligible for coverage, he or she cannot wait more than 90 days before coverage is effective. And again, what are we talking about with calendar days? For purposes of the 90-day limit, it includes weekend and holidays, and it begins on the individual's enrollment date. So there's quite a bit of information here that you'll want to probably refer back to. Now, an example. For example, XYZ Health Plan provides that full-time employees are eligible for coverage. Okay? Employee A begins employment as a full-time employee on January 19th. As a result, employee A's coverage under XYZ plan must become effective no later than April 19th, assuming February lasts 28 days. Failure to comply with this requirement may result, again, in a $100 excise tax and additional ERISA penalties. So very, very important to basically focus on those calculations to make sure you're in compliance with the law regarding limitations related to waiting periods. Now we're going to take on medical loss ratio rebates. Now, what we're talking about here is the plan sponsor's responsibility to distribute medical loss ratio rebates it receives from the insurer. A medical loss ratio, or MLR, many of us know it as MLR, is the amount of health insurance premiums that an insurer spends on healthcare and activities to improve healthcare quality. It's expressed as a percentage. For example, an MLR of 90% means 9 out of 10 of all premium dollars the insurer receives are spent on healthcare and quality improvement, with the other dollars spent on overhead, profits, and administration or administrative costs. Under the ACA, an insurer that offers healthcare coverage to individuals or small groups, usually not more than 50 employees, must generally meet an 80% MLR threshold. An insurer that offers coverage in the large group market, usually more than 50 employees, must generally meet at least an 85% MLR. So it's important to note the difference between smaller groups and larger groups, and also understand that what this is about is really spending money on what's really, really important, of course, which is the actual provision of healthcare and all the important areas that are associated with that. So let's continue on. And we're going to actually do a little bit more on medical loss ratio rebates. An insurer that does not meet its MLR must distribute a rebate to the policy holder, which is typically the employer that sponsors the plan. The employer is then responsible, this is key, for distributing the rebate to eligible plan enrollees. Issuers are required to provide any rebates owed to enrollees by September 30 following the end of the MLR reporting year. Therefore, employers may receive a rebate for reporting year 2017 by September 30th, 2018. Any portion of a rebate constituting plan assets must be handled in accordance with ERISA's fiduciary responsibility provisions. And again, for more information, please visit DOL.gov. And now we're going to take on in our next slide the PCORI fee requirement. Employers that sponsor certain self-insured health plans, including most HRAs and health FSAs, are also responsible for fees to support the Patient-Centered Outcomes Research Institute, or PCORI. These fees are paid by filing Form 720 with the IRS annually, no later than July 31st of the calendar year immediately following the last day of the plan year to which a fee applies. PCORI fees for plan years that ended between October 1, 2017 and December 31, 2017 are due to the IRS on July 31st, 2018. For these plans, the applicable fee is $2.39 multiplied by the average number of lives covered under the plan. IRS Form 720 and its instructions are available for download at irs.gov. So really, I mean, it does require, some bit of focus on this, but it's very specific. We've given you the deadlines. We've given you how the actual fees work and why they're there. And so from there, you should be able to comply and just go to it. You've got the information you need. So let's continue on, and we're going to talk about Form 5500 filings. Finally, all ERISA-covered group health plans with 100 or more participants at the beginning of the plan year are required to electronically file Form 5500 with the U.S. Department of Labor by the last day of the 7th month after the plan year ends. Again, the last day of the 7th month after the plan year ends. For calendar year plans, this due date falls on July 31st, 2018. Instructions for completing the Form 5500 filing requirement are available for download at DOL.gov. In addition, the plan administrator must keep a copy of the form on file and must make a paper copy available upon request to participants, beneficiaries, and of course, the DOL. Now here's something steep, the penalty. Failing to file Form 5500 may result in a penalty of up to $2,140 per day. So you want to be really sure that you're absolutely in compliance with filing your Form 5500s if you are required to do so. And again, to be very careful about the accuracy of the information in the form and the deadlines that we've covered. And now we're going to move on to a completely different topic. We're going to be talking about HSAs, health savings accounts. Now, we're going to be talking about the rules that will apply to several tax-favored accounts in 2018. First, obviously, are the HSAs. These are tax-exempt accounts employers can set up through a cafeteria plan to pay or reimburse the employee for his or her qualified medical expenses on a tax-free basis. To be eligible to participate in an HSA, the employer generally must be covered under a high-deductible health plan, we all have heard it, HDHP, on the first day of the month, have no other health coverage except for the HDHP, not be enrolled in Medicare, and not be claimed as a dependent on someone else's tax return. So very, very important information to take note as it relates to HSAs. And let's continue on. So to be an HDHP or high deductible health plan, the annual deductible may not be less than $1,350 for self-only coverage or $2,700 for family coverage, and the annual out-of-pocket expenses may not exceed $6,650 for self-only coverage or $13,300 for family coverage. In 2018, an individual with self-only HDHP coverage may contribute up to $3,450 into his or her HSA. An individual with family HDHP coverage may contribute up to $6,900. Now, I know these are a lot of numbers that you're looking at right now, but they're super important, both the limits and the HDHP limits, and of course the HSA contribution limits. So please, again, that's why you're going to get all the materials afterwards. Really take the time to study it, and you will have the information that's so critical to compliance with HSAs. Now we're going to talk a little bit more about employer participation in HSAs. Employers can make contributions to employees' HSA accounts and deduct the contributions on the employee benefit programs line of their business income tax return for the year in which they make the contributions. However, cafeteria plan contributions are subject to certain, very important, non-discrimination requirements under Section 125 of the Internal Revenue Code. To satisfy the Section 125 non-discrimination requirements, a plan generally must satisfy 3 tests. First, the employer must satisfy the eligibility test. Under this test, the plan must not discriminate in favor of highly compensated individuals as to eligibility to participate. Very important. Second, the employer must satisfy the benefits and contributions test. Under this test, the plan must not discriminate in favor, again, of highly compensated participants as to benefits and contributions. So there are 2 different sets of requirements, but very, very important to note. And so let's continue on, because we're still barreling towards our third. And finally, a plan must satisfy the key employee concentration test. Under this test, the non-taxable benefits provided to key employees must not exceed 25% of the non-taxable benefits provided for all employees under the cafeteria plan. So there's your 3. Complying with the Section 125 rules is incredibly complex. So, we kind of distilled it down for you. Before making any contributions to employee HSAs, we recommend to contact a knowledgeable benefits attorney or specialist in this area for additional guidance. Although it just didn't take me very long to kind of summarize them for you, they really are complicated, and it would be prudent to contact a professional who is absolutely expert in this area. So it's just kind of, I know there's usually typically a consulting fee and sometimes charged and so forth, but you know what? A little advanced planning and going to the right expert, whether it's an attorney or a benefits specialist, can make such a difference and is well worth considering. So now we're going to talk about, in our next slide, the 2018 rules on health FSAs. Another popular tax-favored account, of course, is a health flexible spending arrangement, or health FSA. Health FSAs are set up by employers via a cafeteria plan and serve to reimburse employees for medical expenses incurred by the employee's spouse, the employee's dependents. So those are the 3 areas. And then continuing on into the next slide, employees contribute to their health FSAs by electing an amount to be voluntarily withheld from their wages by the employer. This is sometimes called a salary reduction agreement. Employees do not pay federal income tax or employment taxes on the salary they contribute. Here it comes, for 2018, salary reduction contributions to a health FSA are limited to $2,650. Employers may also contribute to employees' health FSAs, and the amounts the employer contributes are not taxable to the employee. Very important to remember, and so there you have it. Now, continuing on to the next slide, we're going to talk about health FSA non-discrimination rules. Employers that contribute to employees' health FSAs must comply with the non-discrimination requirements under Sections 105 and 125 of the Internal Revenue Code. We discussed the Section 125 requirements during our discussion of HSAs, right? So let's now discuss the Section 105 non-discrimination requirements. To satisfy these requirements, a plan generally must satisfy 2 tests. Ready? First, there's the eligibility test, which prohibits plans from discriminating in favor of highly compensated individuals regarding the eligibility to participate. In addition, health FSAs must satisfy a benefits test by ensuring that benefits provided under the plan do not discriminate in favor of participants or highly compensated individuals. Complying with the Section 105 rules, again, it's complicated. Before making any contributions to health FSAs, we are again advising employers should seek a knowledgeable benefits attorney or specialist in this area, because you need to get it right. That's really what the bottom line is. So that's really where we're at on this. So you've got the basics and you know the parameters but then extra expert guidance would be absolutely recommended. So let's continue on. Actually, we're actually continuing on to our very, very last slide, which is, I know there's a lot of information for our folks out there, and I want to first tell you, thank you very much for joining us today. I sincerely hope that all of this great information will be so helpful to our brokers and employers across the country. It's so, so important. Thank you again. We will be doing new webinars. We're doing them monthly, and so I just want you to know that. And in addition, I am going to take a few questions that we have seen coming in, and I thought some of them are actually pretty important. So if you bear with me for another few minutes, then we'll be done. So first one is, when does the repeal of the individual mandate go into effect? Because we all know about that. That happened. The Tax Cuts and Jobs Act, which was signed into law by President Trump in late December, repealed the ACA's individual mandate, which requires every individual to have minimum essential health coverage for each month, qualify for an exemption or make a payment when filing his or her federal income tax return. However, this repeal, this is important, does not go into effect until January 1, 2019. Until then, the individual mandate remains in effect. So for all the excitement that happened and the law that was signed, in the act or law that was signed and is it is a law now. That's it. But the requirement is not until, it doesn't go into effect until January 1, 2019. So that's when the repeal goes into effect. A second one is, I thought the deadline to furnish Forms 1095-C to full-time employees was January 31. Was this deadline recently moved? And the answer is yes. In late December, the IRS extended the due date for ALEs to furnish Forms 1095-C to full-time employees this year to March 2nd. Previously, this deadline was January 31st. However, the deadline to file Forms 1094-C and 1095-C with the IRS remains February 28th or April 2nd if filing electronically. And finally, one more question I'm looking at here. Where can I obtain more information on determining full-time employee status under pay or play? IRS.gov has a lot of great resources on pay or play, so we encourage you to go there. And again, if you've got the live HR 360 library, there's a lot of great information there as well. Thank you very much, and I look forward to you joining us on our next webinar.